Hey folks, welcome back. I wanted to give you guys an update on the asymmetric system. It's been a couple of weeks since I put a video out on that, although I've been putting text in our live chat room. Today's April the 13th, 2021, and so we're just about halfway through the month of April now, and I did want to update on the performance so far that has just, I continue to just be astounded by what we're seeing. I just love what we're doing here. But more importantly, I wanted to talk about some of the changes that we put in place here with some of the anchor positions, and I think that that's really the critical talk. Just a quick review for our first quarter here. We got up and running officially, did all of our beta testing, everything in December of last year, got up and running officially in January, and through the first quarter we're up about 10.3% versus a 5.7% gain for the marketplace. So it's important that we beat the market. It's tough to create value for you guys. It's tough to create a scenario where you want to pay a subscription fee for a service that doesn't provide some value-added service, and beating the market is obviously a value-added service, and that's fine, that's great. But remember that this program does have a dual mandate, and the big focus is the primary mandate, which is beating the marketplace, but I would suggest that the dual mandate, or the second mandate, is equally if not more important, and that is doing it at lower risk. And I think the key here was that we were able to do this with about 42% less IV, 42% less implied volatility, or as a lot of just normal investors will call it, risk. 42% less risk, and that's really the key. It's tough enough to beat the market, but if you can do it with less risk, that's awesome. We're halfway through the month of April right now, and we are almost exactly, for our AST program, we are almost exactly up 3% so far for the month of April. Okay, the market, that's an R, April. The market, the SP 500 right now as we speak is up about 4%. So we're not quite matching the market right now, but I feel pretty good going into the last part of this month for a couple of reasons. Number one, I feel like we are destined for a, if not a downturn in the marketplace, at least a flattening of the marketplace. This idea that the market's making 1.5% every single week, 6% a month, I mean, that's just not sustainable. And I do feel like we're going to have a little bit of a correction. Not necessarily a correction, but a flattening in the marketplace. And that will obviously be where we shine. We've talked about this before. The AST program works equally as well in a down market as in an up market. The markets it has a tough time with are where we're getting whipsawed back and forth between short and long, short and long, short and long. So anyway, that's just a quick update. Again, I will tell you that we are right now, we are at about 38% less IV. Interestingly enough, the S&P 500 has been able to log this gain without a whole lot of volatility, without a whole lot of whipsaws. The market moves are really flattening out here, and again, I believe that's indicative of a little bit of a market top here. So anyway, performances are looking really, really strong right here, but what I primarily wanted to talk about was some of the alterations that we've made to the program. So let's jump into our account and take a look. So you can see here, it's about 10:40 at night on April the 13th here, Tuesday. And so this is what my positions are left over from today's trading session. We had a good day today, and a lot of that was attributed to some of our short positions. And I want to talk about that sort of juxtapositioning of having a short and a long trading alongside each other, and what that does to our volatility. So I do have, I've got Facebook here still. That is one of my short positions that has neither hit its stop loss nor its take profit level. But if we leave Facebook out of the equation, you can see I've got IYR, RWM, SLV, SPY, and USO. 1, 2, 3, 4, 5. Now these 5 are now what we would consider our core holdings in the portfolio, meaning that these individual positions do not have stop losses on them. Now, this does a couple of things for us. There's a couple of reasons why we expanded our core holdings. Number one is we wanted to create a greater diversification. And when I say diversification, it's not just spreading our money around, because we're not taking on really any more positions number-wise than we were before. But what we're really doing here is we're creating a non-correlated portfolio. There are ways, and it's very, very difficult to set up, and it's almost impossible to maintain, but there are ways that you can create zero beta portfolios. Now, you wouldn't want to do that because there would be no profit potential in it. A zero beta portfolio is, in its most simplistic example, one position that when it makes, it would be an account with two positions equally opposing. When one makes $1, the other one loses $1. When one loses $1, the other makes $1. So there is zero risk in the account, right? Because they have offsetting positions. Now again, you would never want to do that, because what's the point of being in an account that makes zero money? But the point is that you could construct that portfolio so that you're having money separated into two different places, seemingly very risky places with zero risk. When one loses, one makes. Okay, well, zero beta is not something that we want to approach, but we do want to, again, try to focus on that dual mandate, and the second mandate being achieve our results, whatever they may be, with a much lower volatility than the market itself is experiencing. And so with these 5 core holdings now, we not only have a much broader spectrum of diversification, but we have some interesting things going on in terms of non-correlation. See, diversification is just spreading your money around. Non-correlation is putting you in places that when this goes up, maybe this goes down, and it gives us a little bit of diversification. And where we want to diversify, where we want to non-correlate away from, is the S&P 500. So, it's interesting that our goal here, again with the dual mandate, is to beat the returns of the S&P 500, and we are going about doing that by trying to invest in things that are non-correlated to the S&P 500, and that's the aspect that gives us this edge. We always talk about the edge or the advantage that we try to have in our program, right? IYR is an ETF that tracks real estate, and as you can imagine, real estate has not only done very well. You can see how it's obviously done very well. You can see that delineates our position right now. It's at all-time highs. I mean, that speaks for itself. But more to the point is it's a little bit more diversified away from the stock market. Okay, and we'll talk about the covered portions in just a minute. Now, RWM. This is an interesting one. There were some questions initially when we set up the program. Isn't it a little duplicitous to have the IWM or the RWM, which happens to be the short version of the Russell 2000? Because we've got the SPYs in here right now, right? We've got the S&P 500. Wouldn't that kind of be like having the S&P 500 and the NASDAQ and the Dow and saying that we're diversified? Because those all kind of move in tandem, don't they? Well, what's interesting about the Russell 2000, those are small cap stocks, and small cap stocks do move in a little different manner than the overall large cap stocks do. And you don't have to go too far to take a look at this. We could go look at a chart right here, and you can see these charts sort of put up against each other. This is the S&P 500 right here. I mean, just up, 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 up. And folks, I'll tell you. This I get. Okay, this I get. That is a clearly definable bull market that has its ebbs and flows, its good days and its bad days, and its pullbacks and its rises, but over the long term goes up. This is a healthy bull market right here. Folks, what we're seeing right here, this is neither healthy nor sustainable. It is neither healthy nor sustainable. The market has never, in the history of its entire life, continued to maintain something like this. So we know it's not going to now. We just don't know when it's going to stop, right? But nevertheless, market just screaming to these all-time highs. And again, I like the idea that we are able to maintain this. We are able to actually be beating this market right now with these numbers overall. But again, the market, S&P 500, screaming at the top. Look what's happening to the small cap index now. The small cap index really sort of, it hit its peak back in March, and it's been going down ever since. And so it's interesting. I don't know if you're a good technical analyses individual, but this should be a pattern that, if you know technical analyses, jumps right out at you. And that's called a head and shoulders pattern. These are the shoulders, this is the head, and it is a very bearish signal. Very bearish signal. And so it is interesting that with all of our positions, the IWM as well, we have the ability to flip these from bullish to bearish, from long to short. And we've done that some time ago here with our RWM, as the overall S&P 500 stock market was hitting new all-time highs day after day after day. We saw this weakening starting to take place in the Russell, and we went short there. Now that's been a good working trade for us here, and we continue to, again, maintain a short position in the Russell and a long position in the SPY. What does that do for our volatility? It really lowers it, right? It gets us more towards our ultimate goal, which is to be able to beat the market with 50% less volatility, with beat the market return with half the market risk. Wouldn't that be nice, right? So that's the goal, at least. No guarantees, of course, that we'll achieve that, but that's where we're working towards. And I think these changes that we made right now really help in regards to that. And so let's talk about that second change, which is, again, we've added more core positions, we've created more diversification, we've created more non-correlated aspect to it. And then the third and final thing here that we've created is we've expanded the cash flow portion of the program. Up to this date, recently, all we were cash flowing was our core position of the SPY. Selling covered calls or covered puts on it, as the case may be, if we happen to be short it, and generating cash flow off of that. Well, remember again, with our mandate, we want to beat the market. Well, how do we beat the market? You've got to have something going on. You've got to have an edge of some kind. You can't just say, you know, I'm going to try to pick better things than the market can pick, because over time it's going to be very difficult to do that consistently. So we're always striving to create a greater edge or a greater advantage over the marketplace. The marketplace is completely directional. It only makes money if it goes up. We want to create a scenario with our program where we make money if the market goes up, we make money if the market stays the same, and we make money if the market goes down. Now, we make money if the market goes down, whereas the market loses money because we're able to flip these positions to short positions. Okay, we get that. How do we make money, though, when the market goes sideways? I will tell you that this environment, it is a tough environment right now to try to beat something that is doing that. But that environment, folks, that's not going to last forever. That is not going to last forever. And when the market starts to do this right here, take a look at this. You know, there's a 2-month window right there in the marketplace. From there to there, there's a 2-month window where, yeah, there were some ups and downs. There was a down, there was an up, there was a down, there was an up. But you know what? 2 months went by, zero profit in the stock market. Market was the same price right there as it was right there. The only way the market makes money is if it goes up in price. We want to be able to make money all three ways. And if we can do that, that's our edge. That's our advantage. And so we've expanded the cash flow portion of the program by adding in covered calls, or again, covered puts, as the case may be, if we happen to be short those positions. And we're doing that on the IYR, on real estate. We're doing it on the index that is the Russell 2000, whether it be the short one or the long one. Now, what's interesting here is that RWM, that's an inverse index, right? So we are technically long 200 shares here. In my case, your portfolio size is different, so your position sizing may be different. But in my case, I own or am long 200 shares. But yet the RWM is an inverse index. It goes up when the Russell goes down. Okay, so the Russell's obviously been going up, 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 and this has been going down, 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 down. When do you want to get into something? Up here or down here? So I think we're well positioned for the Russell here going forward. You know, when we see weakness in the Russell, when the overall markets are hitting all-time highs, what would the Russell do if the overall markets started to show some stress and some cracking? Hopefully we're well positioned there, but we're cash flowing that as well. Silver, of course, that kind of goes without saying that precious metals or commodities really of any kind are sort of separated from the overall equities market. They kind of move to the beat of their own drum. And silver, as we look at it right now as well, you can see that we're just at about the break-even point, but you can see that it's been coming back here nicely. And there's a lot of buy signals coming into not just silver, but all precious metals right now. And that could push us considerably higher to maybe the 25 level. SPY trade. So we'll talk about the SPY trade here in just a second. And there's a couple of good questions that we had in the chat room over the last week about when and why do we roll the covered portion. And so I want to talk about that in a little bit more in depth here. But that's obviously the SP 500. And then the USO is oil. And oil, of course, again, a little bit different correlation versus the overall stock market. So one of the things that you can see with all of these positions now, all of our 5 core positions, is that we are cash flowing them. There's $80 of extrinsic value still left right there. $86 of extrinsic value still left right there. $61 of extrinsic value right there. $67 right there. That's all money that we will get. Now, that does not mean that it will result in an overall profit. That means that that is income that we are owed, that we will get on these positions. Okay? And so, again, if we can just do something, this market that we are in right now, where the market is going up 1.5%, 2% a day, every day, guys, we know that's not sustainable for the long term. Long term, most people would be happy if the market every year generated about 12% return in a year. That's been the average, and most people are happy with that average. And so if we can do something like this, that in and of itself can generate a 1% return. In other words, on my $30,000 account, I'm generating over $300 a month just in income, just in cash flow. Right there, that gives us a little edge. That gives us an advantage over the market. The market has to go up by 1%. We don't have to go up at all to get that 1% cash flow. But I do want to talk a little bit about this concept of the rolling the S&P covered portion and when we roll it. So if you look at our, there we go. If we look at our portion right now, you can see that there's a couple of things that happen. So we have an anchor position. This is our anchor position right now. It's a LEAP. It's a long-term equity anticipation security. It's just a really fancy acronym that says that your option has more than a year or so of expiration in it. And so generally LEAPs will expire in January of every year, and they go out 1 year, 2 years into the future. We're using this March 31st one here, which is pretty close. It's 352 days, excuse me, to expiration. We set those up with an 80 delta. That gives us a very good approximation of the stock in terms of how it's going to move up and down, the S&P, the SPY, how it's going to move. And then we cover that by selling weekly short-term options. Now, let's talk about the ebbs and flows of this and the pros and cons of changing this out, okay? When we originally set this up last week, we bought this March 31st 345 strike call, and the market was down just below this. I believe the market was around 405, okay? So we sold this 408. Now, when the market's at 405 and we sell a covered call at 408, that gives us the best of both worlds. That gives us some appreciation potential in the SPY, and it gives us this guaranteed income, right? It locks us at a profit level. But it gives us both. It gives us opportunity and certainty. Opportunity to make a profit, certainty that we'll have an income coming in. Well, now you can see over the last week that the market has risen above our 408 call, okay? Now you may think, well, that's bad. Actually, this is good and this is preferred. This is where we would like to be right now, because it gives us still a guaranteed income stream, but it gives us much, much higher safety levels, right? So if we look at this position right now, you can see today was a very, very good example of this trade. You can see if we look at the numbers here in our SPY trade, this is the one that I wanted to show you right here. $61 of extrinsic value. Okay, now this is roughly for me about an $8,000 position, and you can see that we brought in $300 of income on this trade. Okay, so we brought in $300. There's $61 left in that position still for us to be able to garner. Okay, now as we look at that, you say, okay, well the market's at, let's call it 413. We're obligated to sell it at 408, right? What does that mean for us? Well, it means a couple of things. If the market continues to go up, these two positions just offset each other. And look how closely they did that today. Okay, the market went up, so our long position right here made money. That makes sense, right? The market went up, our leap went up in value as well. But we're obligated to sell the market at 408, and the market went up to 412. So that actually hurt us right here, but it hurt us in an equal amount. We are fully hedged right here, okay? So if you say, well, we're fully hedged again, I thought that was the idea of zero beta, and what's the point of having this? Well, the point is that we're going to get that $61. Every single day that goes by, you can see we have about $14 right here. $14 in theta. Every single day about $14 should be coming in as this option becomes worth less and less. Okay, so why are we ideally positioned here? Well, this does a couple of things for us. If the market goes up right now on our SPY position, we make money. We're going to make that $14 every single day. If the market stays the same, we're going to make that $14 every single day. If the market goes down, we have a safety net. Meaning, guys, this market can go from 413, 412, where it's at right now, all the way back down to that 408 level, and we don't give back any profit on this trade. Because the max profit that we can get is up to 408. So we're not hurting ourselves if this market drops from 413 back down to 408 this week. So obviously it makes sense that if you have a position where you're making money every single day, if the market goes up, stays the same, or goes down to a certain level, predetermined level, 408, that you've got an edge. You've got an advantage over the market, which has to go up. Of the 33% probabilities that it has to do every day, it has to go up to make money, right? The problem that this creates, and we'll look at this right now. You see here that we brought in $303. That was the income that I brought in when we originally sold this 408 call, right? That was before it was in the money. Well, what happens now if I want to go roll this expiration out? Let's go out to next Friday, and let's just look at rolling that. What does it bring in? $108. $108. We went from $300 of income to $100 of income. Now, that's not necessarily bad. See, there's pros and cons, right? When we originally sold the option for $300, we didn't have any downside protection. Now we're only going to get $100, but we have downside protection, right? So there's pros and cons in both ways. The problem becomes, and this is what happened with ours last week, when we get so far in the money that these credits are $30. $40, right? See, I'm willing to take a little risk for $300 income. I don't want to, give away all of the risk because I'm only making $30. That doesn't make sense either. So we want to find a sweet spot in these trades. And so generally you will see that when the rolls get to where we are bringing in less than $100 on each roll per contract, that we will reset the whole trade, okay? So just a couple of quick updates there, guys. I am just absolutely thrilled with how things are going so far, and I would love, for our purposes here, for our sort of selfish purposes, I would love to see the market turn bearish. so that we can really stretch our legs here to the downside. All we have really seen here is a little smattering here and there of some bullish and bearish trades, and that's what we do with our non-core positions. Every day we're giving you non-core positions that are bracket orders where we put a 1% risk, 3% profit take out on them, automatic. We're always going to have a mix of short and long positions in there. In fact, I'm looking at tomorrow's trades, and half of them are short positions, even the market is still bullish at this point. But that meters out the risk, that manages the trades in a little bit more smoother fashion, and that's fine. But I'm excited to see when, not if, the market turns to the downside. And I think that that's really where our performance shines. You guys all know that the market can and has many times lost 20% in a 1 month period of time. 20% in a 1 month period of time. And all it takes here for us to blow the market returns out of the water for an entire 1 year period would be for the market to lose 20% in the year and us to make 5%. That 125% swing would be almost impossible for the market to make back up again. And it would, again, meet our dual mandate of beating market returns with much less risk. So I think that these returns are these changes, guys, they're going to help us with our volatility. They're going to help us with our edge. And just a note, I will tell you here that we are going to continue to test this. We're going to continue to tweak this. One member asked me recently with these new changes if we're done. And my answer was, I hope that we're never done. I hope that we're never done tweaking and refining this system and giving you guys a very clear vision of how we are meeting our dual mandate and why it's so important to focus on that. So anyway, quick update, guys. I hope all is well with you. We'll talk to you soon. Oh, by the way, for those of you that have been asking about a free trial to come see our results in the asymmetric system, you are absolutely welcome to come do that. If you want to go to the link below, the bit.ly link, I will let you set up a free 2-week trial to come see our results in our trading room, chat with us, interact with us, ask any questions that you have. Hope to see you there. Thanks, guys.